Happy summer, D2 community. Welcome to this special edition of our D2 Investment Guru series. You know, a lot of you have had concerns about new asset allocation requirements, some of your investment vehicles going away. So we built this special series to hear from one of our very best investment practices in the entire country, Drew Watson, our D2 investment guru. You're going to hear from him on what he's doing, how he's combating these changes, and what you can do about it. So stay bullish, D2 community. We look forward to speaking with you soon in an upcoming coaching session.
Hello, D2, and welcome to our webinar series. I wanted to start today's topic with a little bit of a market update of what's gone on over the summer. If you weren't able to join us in our last D2 meeting, one of our focuses will be how to take this information and really go deeper with your clients and use it as a business acquisition and business retention tool. With that said, what we've seen moving markets in the last 4 to 6 weeks have been more about interest rates. In June, interest rates went down and they continued their downward spiral, and then they have turned pretty quickly right around month end of June back to the upside. The reason why this is important is this is the 10-year treasury that we track, and it has gone from about 2.17% to about 2.38%. The reason why that's important is the 10-year treasury versus the 90-day T-bill rate is the best recession indicator that we can find. And even just this morning, I've been hit with clients wanting to know, is there a major correction coming 4 to 6 weeks away, as a lot of the internet outlets are predicting. And what we can go back to is our interest rate recession indicator as well as unemployment rates. But be it as it may, the investment conditions have been pretty benign still yet for risk-on assets. So that means stocks have continued to perform pretty well. Within the stock market, what we've seen is a rotation out of some of the tech stocks. They've kind of hit their ceiling or peaks temporarily, as it were, and money move into some of the beaten down areas, such as financials. Oil has also seen a little bit of a bid here and a move up in the last few weeks. And even telecoms, which have been crushed in the last 6 months to 7 months, have seen a little bit of a reprieve and an upturn. So when it comes to stocks, we are a little bit more optimistic, especially on our international allocations. And within the investment models that we've been running, we've been continuing to make additions to both developed and developing markets. There has been ups and downs, and most of the developed market headwinds have been because of concerns regarding Brexit or other geopolitical issues. And in the emerging market, since China is such a large constituent of the index, anything going on within their borders or with the North Koreans has seen volatility. In the longer term, though, we feel like these markets offer a very good investment opportunity. Specifically, eventually the U.S. recovery will peter out, and traditionally the European markets have been 2 to 3 years behind us. That might find a little bit more of a safe harbor equity play for your clients. As we move to fixed income, what we've seen is bonds rallied in price through June as rates went down, but have had a little bit of pause of rates that have increased in the near term. Also, we've seen more volatility in municipal bonds, and if you're using a bond fund or a bond index, it's very important to note how much of that bond weighting is in Illinois bonds. It's been well documented the state of Illinois had operated without a budget for several years, and I know our wholesalers of funds have kept us up to date with exposures. For example, we have a fair number of clients from Illinois. We know on some of their most at-risk bonds, the pricing has improved over 15% just in 2 weeks as a budget deal was reached, and we hope that will continue in the state of Illinois get their house in order. On the alternative space, our biggest alternative holdings are in REITs. The Blackstone Mortgage REIT continues to do very, very well. There's a Virtus Global REIT that we have explored and started dabbling some money into that as well. And even though rates are rising, in an overall sense, it still appears that REITs have a spot in the portfolio and that they should be able to generate very competitive yields in this relatively low investment environment. Also in the alternative space, gold and silver have had so-so years, and then unleaded gasoline is another position that we've had. And with oil prices being a little bit resurgent last month, we have seen an uptick in unleaded gasoline, the UGA that we operate with as well. The situation on the commodity patch has centered around oil, not so much gold and silver, and oil has been bouncing around say $43 a barrel to maybe just over 50. It's as the way things look today, it's highly unlikely that oil would have a tremendous run over the mid $50 barrel range. And I think the last number I received for year-end top end estimates was maybe $54.50, but under $55 a barrel specifically. We'll continue to utilize and look for other non-correlated assets. One that has continued to do well, that's kind of a quasi bond stock holding, is the convertible bond fund from Mackay Shields. Mainstay Investments is who we use. That's done pretty well, as well as other replacements we're looking for, since we did have 2 or 3 holdings that are no longer going to be available on SPS on the Ameriprise platform. The largest being the Permanent Portfolio Fund, which fills a lot of that alternative space for us. So once we get a replacement on that fund selected, we will let you know. Hello, D2 World. There's 2 topics to discuss today with you regarding investments. One being the Ameriprise fiduciary reviewed list, as there are quite a few investments that will no longer be available and supported on the SPS or SPS Advisor platform. And the second being, where are you with your asset allocation policy, and how are you going to document that for your clients? Let's tackle issue number 1 first. Primarily, we do feel like you need to be proactively making changes, because I think the worst thing that your clients can get is a letter from Ameriprise saying you're invested in a position that's no longer supported by us and we're going to move it to a different type of account. It's better to control the conversation from the front end. And as I stated in our investment call, we have 2 or 3 positions that we are already making changes in. Specifically, a couple were just moving from one ETF to another based on what volumes were, and we've let clients know that in our models that those are the reasons we're making those changes. Secondarily, with some of the funds that have been changed, we've moved from the Permanent Portfolio Fund into a different replacement that we're following up on and finishing now. Specifically speaking, that conversation is more around what is appropriate for the clients and what is going to be supported. We don't think there's anything wrong with a permanent fund specifically in this instance, for example. It's just that we need to find a more alternative investment that fits within a larger portfolio and may even be made up of some of the same constituent securities that our permanent portfolio has. Whatever your situation is or the numbers you're using, we do feel you want to be proactive and search out what are some available options for you on your platform. The second issue is a little bit larger. It has to do with asset allocation and what templates are available and what support might be available for the home office. As we go down this road in our practice, we have found the best practice to be the KISS method. Keep it simple. And so simplicity, we are using the larger IRG terms to determine our asset allocation: cash, equity, fixed income, alternatives. Then you have non-classifieds. Utilize the timeframes available, and this is a great tool to target asset allocation piece that Ameriprise has made available. And the timeframes are 0 to 3 years, 4 to 7, and 8 to 15. If you do quite a bit of discretionary business, what you could do also is marry the discretionary kind of asset allocation quilt or account type quilt to this system. Specifically, all you would need to add is an all equity module and then put in your different percentages there. Using the SPS Advisor platform as a basis, typically if you look at the variance, how much drift can be in a model to use for equities or fixed income, what we found is the average variance is about 22% off the center point. So this may sound like a lot, but it gives you a pretty good drift. And I think the key is, how do you explain that and document that explanation to your clients of whether you are within the acceptable tolerances of the model portfolio and their asset allocation, and you're going to continue using it, whether or not you're outside the acceptable variances of the asset allocation and you're going to continue using it for one or two or three reasons that you document and that make sense, or you're outside the tolerances of your asset allocation and you're going to make changes into the following model or asset allocation. I think if you keep this robust and document it, our best practice will be to do it pretty much every meeting. That way we'll know we'll have the requirements met, but also it lets your clients know that you are on the same page with them with how much risk you want to take. As a practical measure, what I foresee happening is, once volatility returns to the market, clients will probably want to change their allocation to something to be less risky than what they are now. If your models have a decent amount of variance built into them, you probably won't have to change much of your documentation other than you've had a conversation with your clients, and due to current market conditions, a change is warranted. Other times you may be able to talk your client off the ledge and stick with a longer term investment time frame that fits and is more consistent with their longer term goals. One area that we feel is an opportunity now is for those clients that have ridden this wave of the equity markets up but continue to tell you they don't want to take much risk. This is an absolute golden moment, if you will, to sit down, re-engage with them in planning and say, based on your stated risk tolerance of not being very risky versus where you are now, there's a big chasm here. Here's how we can fix it. Keep that in mind as you prospect new business, because specifically speaking, we haven't seen any types of changes at other firms, and this might be an opportunity to reach out to those clients on your prospect list so they can know more about what we're doing here at Ameriprise, but also within your practice specifically to make sure that they are fully engaged with you on what their risk tolerances are. Very often on new clients coming in, their stated risk tolerance versus how their money is invested will be miles apart. And you can only imagine, in the world of other investment providers, there's probably tremendous opportunity to bring people in to basically more realign what their risk tolerances are to how their money's invested. I think everybody with any tenure at all here on the call will notice that most often and more often than not, clients will state that they are more conservative than how their money is invested. And then they'll also cite that they just don't know much about how everything works and are unfamiliar with how things go on. So this is a very, very good opportunity to try to get in front of prospects and reconfigure what's happening there. I think another prospecting tool is to use the same asset allocation methodology with their outside assets, specifically retirement plans, because this could open up an entire conversation about in-service distributions and after-tax money in these plans to help make their asset allocation on a global basis more of a reality than having the money invested differently in their plans at work versus what you have in the office here at Ameriprise. So those are the two big issues that we are working towards as the summer comes to a close, and we should have everything nailed down by Labor Day on how we're going to present, package, and document the asset allocation changes, and certainly within a few days the changes on the fiduciary testing of the investments within the SPS and SPS advisor accounts. Another opportunity I would close with is, as often people really will say they are more conservative than how they're invested, would be to look at the IUL products that RiverSource has. Specifically, there's really no other way to get the no downside protection and an 11% cap than the IUL insurance products. Reach out to Travis Cremines at D2 or your local RiverSource wholesaler to get more information on these products. But as you open up this asset allocation discussion with your clients, I think what you would find is there may be a fit for more appropriate insurance business within your practice than what you're currently finding. Have a great summer, and we'll speak to you all again in August. Thank you.